In this video, I'm going to make a comparison between the VOO and the QQQ. Now, if you don't know what that is, the VOO tracks the S&P 500, whereas the QQQ tracks the Nasdaq 100. And the difference here is the QQQ is more tech and communication, and the VOO is more tech and finance. So another choice is which one is best. And now I'm going to get into that right now. Let's start with the S&P 500 Vanguard ETF, also called the VOO. Now, as you can see, slowly but surely this just increased in price, so it just continues upwards and upwards and upwards and upwards. This is of course because it follows the S&P 500, and of course the broader market increased in price, so this will as well. Now, this doesn't mean that you can't lose money on it, of course, because we have some poor times sometimes, like 2022, where over a longer period of time it wasn't that great to own. Say you bought some in December of 2021, before you actually had a return on your investment, you had to go all the way over here to January of 2024. Now, that isn't that fun to own, of course. And that is in these broader market terms, when it's in the best stock market, of course, you're not going to see that great returns on the S&P 500. But unlike maybe a poor stock, this is going to perform at some point again. Hopefully, of course, that is not promised, but more likely than not, it's going to perform again. Now, some stocks you might still be in minus in 2022, but overall, a ETF like VOO is going to perform again. We also have some small flash crashes, of course. We have the COVID-19 right around here, and we also have the Liberation Day up here. Now, when you have these smaller market crashes in short periods of time, of course, it is going to fall again. And personally, I do like to buy up ETFs in times like this because it is more safe that they are going to increase than simple stocks. Now, something I also like is that they pay out dividends. You can see that right around down here. These are always the dividends. You don't see how much they pay out, and that is 1.12%. Now, this isn't amazing, but overall, I just am a dividend investor, so I like this quite a lot. Now, if we look at the performance over the past 10 years, so if we go back to 2015 and look at the average, as you can see, it's only 4%. You're going to notice the average falls off quite heavily. That's because the dollar has fallen off quite heavily, and this is just making sure that, say that you bought it in a currency that wasn't dollar, let's say you bought it in euros, then your return would be quite poor. But if we take 2014 to 2024, the average would be 12.09%. Of course, quite nice. A average market, of course, returns 7% a year. So if you just bought this, you would have outperformed the market, of course, if you didn't purchase in some other currency. Now, if you look what's inside the fund, you can see that right here. We can see, of course, the expense ratio is also quite low. The expense ratio is how much it costs you to own this ETF. That is quite higher in the QQQ, but you can see that later. Now, what do they own? They own electronic technology, technology services, and finance. And this is quite important because QQQ does not own finance. They own much more consumers. But if we go into the holdings itself, we can see they have their main stock, of course, is Nvidia. That's no surprise. We have Apple, Microsoft, Amazon, Broadcom, Google, Meta, Tesla, and Berkshire Hathaway. And I like it quite a lot that they own Berkshire Hathaway because this is, of course, one of the largest financial institutions in the world. And the QQQ does not own this. Now, if we go down here to the technicals, course, funds have technicals just like stocks do. For the day, it's a buy, a week, it's a buy, and for the month, it is a buy as well. So overall, in the long term, it's going to be quite safe to invest in a ETF like VOO because in the long run, you aren't going to lose money if the market is behaving like normal. But of course, I can't predict the future. But it is a safe bet to put some of your money in the VOO. So let's say you have a portfolio and you want something just in the bottom, say 10-15% of your portfolio, just be slowly but surely growing. VOO is a great place, or for retirement. Of course, I have some of this in my retirement as well because it is simply just such a great ETF to own. Now let's get into the QQQ as well. Now, of course, as you can see here in the QQQ, it is absolutely the same as the VOO. Slowly but surely, this stock price just increases and increases and increases. Now, some years when, like 2022, it was quite poor to own, but this actually performed even worse in 2022 because it is quite tech heavy. As you can see, it wasn't that fun to own. But just like Liberation Day as well and COVID-19 as well, it crashes. But of course, that is a fund. Now, if we go into what is in the fund itself, as you can see, something important is the expense ratio. This is quite a lot higher than the VOO, and we also have assets under management that is about a little below half. Now, if we go into what is in the fund, we can see electronic technology and technology services. That is much more at 35% and 31%. As you can see, we don't even have any finance at all. We also have quite a lot of retail trade. Now, if we go into the holdings of this company as well, we can see Nvidia is, of course, the biggest one. We have Apple, Microsoft, Broadcom, Amazon, Alphabet, Tesla, Meta, and Palantir, something that is not so high up on the list in the S&P 500. So if you have a more aggressive approach, the QQQ might be a bit better for you to own. Now, if you go and look into the seasonals as well, so you're going to see this. So if you go back to 2015 again, we make an average, you can see that, of course, the dollar currency dropped quite a lot. Therefore, this also average is quite poor. But if we take it from 2014 to 2024, you can see the average is actually almost 6% higher in this than the other one. So of course, if you are quite happy for tech, QQQ is a bit better for you. If you want to go a bit more defensive, you should go into the VOO. Of course, you should be thinking, well, which one do you like the best? Well, if you like a more defensive stock market, I think that maybe the VOO is for you. If you think tech is going to take a dump, don't buy the QQQ because it is just going to be a poor feeling that if, of course, Nvidia and Palantir and so on and so forth crashes because it is so heavy into the tech. So the general rule of thumb is if you're into aggressive stocks, invest in the QQQ. If you're into more defensive and a broader market, invest in the VOO. Personally, I do prefer the VOO a bit more, but that is because of my other stocks. And remember, of course, this isn't financial advice, this is purely for entertainment and educational purposes.